Greenland Minerals has dealt a blow after snap election results. Welcome to Kitco Roundtable. I'm your host, Michael McCrae. With me is editor Neils Christensen.
Hey, everybody. Happy Friday.
Kitco correspondent Paul Harris.
Hey, good afternoon.
And with us is a man who seems to rightly guess all of mine's developing trends. It's Douglas Silver. Douglas, welcome to Kitco.
Hello.
Douglas is founder of International Royalty Corporation, which he sold for a pretty penny. He also helped get the Denver Gold Group off the ground. Later in the podcast, Doug is going to argue that a lack of mining discoveries is actually a very old story, and maybe juniors, they should keep those preliminary economic results to themselves. Doug, we will get to all this later in the podcast, but maybe first you can help us out with some career highlights.
Yeah, well, back in the Jurassic, I got a master's degree in economic geology and started out as a prospector for one of the big mining companies. That led to us making a molybdenum discovery in southern Colorado, which got me promoted into their newly formed acquisition team. And for somebody who just wanted to be a natural scientist and a field guy, I got the bug on acquisitions, finance, and all of that. I was in charge of investor relations for Bond International Gold, which we took public in the late 1980s, which we subsequently sold to another company. And then I went out as a consultant, and I spent 20 years doing appraisals, valuations, acquisitions, mergers, and a little bit of financing. We built International Royalty, and 5 years to the day, we sold it. We did very well for our investors. I did the right thing. I took a year off to fish and ski. And then I got sucked into the world of private equity, where I've spent the last 10 years working for the world's largest private equity firm in mining. They manage about $6 billion. I retired in December. So the highlight of my life going forward, at least at this point, is teasing grandchildren and trout and doing podcasts with really, really interesting people.
We will take that compliment, Douglas. As we were talking earlier in the podcast, you are retired. You've had, would you say, some salty opinions just regarding the industry and how it can fix itself. We're looking forward to that discussion. But first, we always start with Neils. We might be in for an early rate hike with the Fed. Is that correct, Neils?
Well, so Friday, the Bureau of Labor Statistics, they were supposed to release their producer price index this morning. It was about delayed by like half an hour. Their website was down, so the data was like delayed by half an hour, and then it comes out. Producer inflation prices are, I wouldn't say off the charts, but they're really high. They saw annual inflation is at 4.2%. The highest increase since September 2011. And you'd think like this inflation noise would be good for gold. You know, higher inflation means lower real interest rates. However, what's happening now is that these bond guys, the bond market, is worried that this inflation is going to lead to rate hikes. So there's this real interesting new dynamic in the marketplace. It's not just improving economic data, thoughts of a robust economy that are driving these bond yields higher. Now it's this threat that inflation is going to go out of control, and the only tool the Fed has is raising interest rates. Surprisingly, though, gold still is holding on. I mean, we're going to end the week with a 1% gain. So it's just, I think we need to sort of wait and see. Before Friday, there was a lot of optimism in the marketplace. You know, gold had that double bottom last week. On Thursday, it pushed back above $1,750 an ounce, which is sort of the low watermark that a lot of people have been waiting for. So we're going to have to now wait and see how this new dynamic plays out.
Paul.
I think that talks to how, the contradictory nature of people that follow the gold space, because, for a long time it's been, all this government debt, all this, all this extra liquidity in the market, all this extra money supply, it's going to be inflationary and that's going to be good for gold. But then when it seems that it's on the horizon, it's, run away. Careful what you wish for, I guess.
Yeah, you can't, gold investors can't win. But I think we do also need to put this into perspective. I was talking to one Carlos Atigas at the World Gold Council this week, and we were talking about, this rate environment. And, they're not expecting the Fed to do anything. The Fed is saying that they're not going to do anything. So, even if they raise interest rates, I do think they're going to be behind the curve. And even if rates rise, real interest rates are going to remain low. And I think that's what investors sort of need to pay attention to. There's definitely going to be a lot of noise in the marketplace as we progress, as vaccines roll out and we see this economic recovery. IMF came out this week and said the global economy is going to grow 6%. The U.S. economy is going to grow 6.4%. There are reasons why bond yields should be higher than they were, 6 months ago. But we're going to have to wait to see what this new dynamic. And it's like, everybody's been talking about the threat of inflation. And now that it appears to be coming in, and this actually is in line with what a lot of companies have been saying. A lot of companies are saying that their prices, for raw commodities are going up. And the only way these companies are going to be profitable is if they pass it along to consumers. So the PPI wasn't really a surprise, but it was just a shock that it's cementing a lot of these concerns. Something I've been saying for a while now is the threat is real.
But to what extent is the potential for rate rises? Is it the boy crying wolf? Because again, go back, there's so much debt out there. How realistic is it that rates can rise? Because politically, that's going to be incredibly difficult to sell.
Thanks. I was listening to the Dallas Fed this morning when I was driving up, and they said that while the Fed had to be very proactive to save the U.S. economy, now that the economy is starting to open up, they're going to use a wait-and-see attitude. And they're still terrified with the impacts of the virus and its variants. But they said that they're not going to be making policy decisions based on 1 day or 1 month or 1 quarter. They need to see concrete evidence that the virus is under control and that the economy is growing. And then they're going to be more reactive. So they're actually in a transition phase right now from being proactive to being reactive. And they said getting that balance correct is really, really difficult. And that's the challenge facing them.
Because one of the other sort of, policy aims is to maintain employment or to increase employment. And my understanding, correct me if I'm wrong, is that, they're prepared to accept a bit of inflation if employment's maintained. And obviously, if you start raising rates, that could have the contrary reaction in terms of employment could start falling.
Well, yeah, exactly. The last thing the Fed wants to do in this environment is raise rates. The economy, 9 million people are still out of work. We're nowhere near the levels that we were pre-pandemic. So the last thing the Fed is going to want to do, and the last thing they're going to want to do is even talk about potentially raising interest rates. And I think this is why Powell keeps banging this drum that inflation is going to be transitory. We're going to see some spikes, but really, it's because if he starts talking about inflation as a real threat, then he's going to have to do something about it. So now, if he downplays the risk, maybe he bides his time for a little bit longer, and they can see. And I completely agree with Doug is that they're going to be on this. They're going to try to be playing catch up, and it's how does that work out? It's going to be fascinating. It's going to be fantastic.
Douglas.
So since we're all math whizzes, if Mr. Biden's infrastructure bill gets passed, the U.S. government will have spent somewhere between $6 and $7 trillion in the last 15 months. Don't you think spending that money might create a few jobs?
Yes, but but and I guess where does that money go though too? How much? The government is not known for its efficiency when it comes to spending. How much real pork barrel is out there in that 3 trillion? I agree, and we're in this such unknown period that I actually don't understand why gold prices are not higher. Interesting. Bank of America came out this week and said that they think art, wine, and classic cars are a good buy to preserve your wealth. I don't know why we're not looking at the fundamentals and why gold is not a lot higher.
So
I want to move on for a sec. I think there was one other piece of news that we should touch on, Niels, for the week, and that was the ETF flows. Those are very bad for gold.
Yes, but they're also backward looking too. So March, this was going to be my one number of the week, but I had a whole bunch of numbers. So ETF outflows, 107.5 metric tons fled the gold market in March. The numbers are quite astounding. However, again, I talked to the World Gold Council about this. And you do have to put it into perspective. I mean, last year was historic, unprecedented ETF demand as we dealt with this pandemic. So, should we be seeing some pullback? Yes. So the ETF outflows dropped about 10% in the first quarter, which was in line with the price decline. But again, you got to look at the bigger picture. And I think, at some point, the inflation scare, I think, is going to bring investors back to the gold market and to the ETFs.
From a backward-looking survey, I guess, to a forward-looking survey, what does the weekly gold survey say, Niels?
Well, it's really interesting. Sentiment is quite bullish in the near term. It flipped both Main Street and retail investors are bullish. 60% of Wall Street analysts that we talk to are bullish on gold for next week. And 65% of retail investors who participated in online surveys are bullish, which was a surprise because retail investors have sort of been this laggard in the survey for the last couple of weeks. They really haven't been bullish or bearish. It's sort of been equal across the board. So the thing, though, is that people want to see sustainability above 1750, and really the magic number is almost 1780, 1768. If we get back above that, I think the momentum kicks back in. Sentiment really gets a shot in the arm, vaccine, as it were. And thank you, Doug. Thank you. I think that's what everybody's waiting for. Sentiment is there. We just need a kick in the pants.
Let's switch to junior miners, but first, our sponsor. Revival Gold is a growth-focused gold exploration and development company which is advancing its Bear Track Arnett Gold Project in Idaho. Bear Track Arnett is the largest past-producing gold mine in the state, hosting a multi-million-ounce resource of gold. The project benefits from existing infrastructure, including roads, power line, and existing ADR processing facility. Preliminary plans are for a restart of the open pit heap leach operations, which will produce 72,000 ounces of gold per year. The all-in sustaining cost of gold will be $1,057 per ounce. The leach operation is to be followed by a second phase mill operation and a much larger scale of production. CEO is Hugh Agro, who has several years of executive experience with stints at Kinross and Placer Dome. He was also a past Roundtable participant. And this week, the company has a giveaway. The first 25 people to email info@revival-gold.com with map in the title and their mailing address will receive an Idaho mining property map. To learn more, visit Revival Gold, and we thank the team at Revival for its support. Paul, Osisko adds 10 years to Windfall in its PEA update.
Yes, I think this could be a good prelude to a subsequent discussion about PEAs with Doug. But Osisko Mining extended the potential life of its large Windfall Gold project in the Abitibi Greenstone Belt of Quebec in Canada by 10 years in an update to its preliminary economic assessment. It now says production will average 238,000 ounces a year from a 3,100 ton per day operation at an all-in sustaining cost of $610 per ounce, which is significantly higher production. Well, it's higher production and a significantly lower cost than the 218,000 ounces annual production at $704 per ounce in the prior study. The updated project would yield an after-tax NPV of $1.5 billion Canadian at an internal rate of return of 39.3%. First 7 years of production would see Windfall produce over 300,000 ounces a year.
So, look for Cisco's head, Sean Roosen, joining Kitco Roundtable later this month. Sorry to interrupt you, Paul.
No, you carry on. I was just, done.
Okay. Well, it's up next. Skeena, SK Resource leaps to 3.9 million ounces.
Yeah, there's a couple of big announcements this week. Skeena announced an updated mineral resource for its SK Creek gold-silver project in the Golden Triangle of British Columbia in Canada. They reported an open pit and underground measured and indicated resource of 38.5 million tons grading 2.3 grams per ton gold and 52 grams per ton silver, containing 3.9 million ounces of gold and more than 101 million ounces of silver, which is an approximate fourfold increase over the number of ounces contained in their maiden September 2018 resource.
And Hudbay sees a 27-year copper mine at Mason.
Yes, another interesting PEA this week from Hudbay Minerals. Mason is a copper molybdenum deposit in Nevada in the United States, and their PEA outlined average annual production of 112,000 tons a year of copper for 27 years, with 140,000 tons a year over the first 10 years from a 120,000 ton per day operation. And that would be a $2.1 billion development.
These were your words, not mine, but you said that Los Cerros porphyry hotspot is showing long legs.
Yes, Los Cerros is an Australian gold exploration junior with a project, with a Quinchir project in Colombia, where I'm based in Risaralda. And the last several months, they've been putting out some very interesting long porphyry drill intercepts. And this week, they announced an intercept of 582 meters, grading 0.94 grams per ton gold at their Tesorito South deposit. Their stock price has tripled, quadrupled over the last year, and they've had a 4 times oversubscribed financing last year, and they're really hitting the drills and starting to get some increasingly interesting results there.
Now, in your Canadian Explorers segment, you noted Talisker, our friends that are working in British Columbia, Troilus over in Quebec and Ontario, Eastern Canada, and Moneta.
Yes, it's interesting how each week seems to have a group or a theme of around sort of news releases, and this week it's very much extensions to existing or known ore bodies. Talisker Resources reported high-grade gold intercepts 750 meters below and along strike from the historic King Mine at their Bralorne project in British Columbia in Canada. Highlights included sort of 90 centimeters grading 9.95 grams per ton. And so there seems to be a lot more potential for them to sort of go back and do the infill drilling there. The company expects to close a $19.1 million Canadian financing in the coming days, concurrent with New Gold taking a 14.9% stake in the company. Bralorne has direct road access to New Gold's New Afton mine. So it looks like there's some increasingly interesting things happening there. At Troilus Gold in Quebec, in Canada, they extended the strike of their southwest zone at the Troilus Gold project by about 400 meters, and that now totals 1.5 kilometers strike length. And they also extended the deposit or the resource 400 meters below its August 2020 preliminary economic assessment pit shell. Drilling highlights there of 4 meters grading 2.23 grams per ton gold equivalent. A 2020 PEA for Troilus outlined a 22-year mine life, targeting average annual production of 246,000 ounces a year over the first 14 years. And in Ontario, Moneta Porcupine Mines hit gold mineralization at its Golden Highway project along 700 meters of strike length in what they call the gap zone between the Southwest Underground deposit and the Windjammer South open pit deposit. This is a project in the Timmins district, and highlights there included 32 meters grading 1.6 grams per ton of gold. So explorers in Canada are extending and filling in their gold deposits, getting much bigger.
We should note that two of those that you mentioned have been past guests on the roundtable, the head of Talisker and also the head of Troilus. We're going to switch to mining. Paul, you noted that copper production in Chile is off to a slow start.
Yes, copper production this year in Chile, I think it's down about 5% over the same time last year. Chile managed to sort of pretty much maintain copper production throughout last year, despite the COVID-19 virus and all the restrictions and on business that placed. But this year has been a very sluggish start to the year. It was the lowest monthly production figure, aggregate production figure for more than 2 years. So, copper supply may be tightening.
Douglas Silver set this up for us well. He did mention Sandstorm's Nolan Watson, and apparently he wants to shore up his stock price, Paul.
So Sandstorm's Gold has renewed its normal course issuer bid. It ended one in the end of March, and now it's relaunched now on to purchase up to 19 million shares, about 10% of its issued and outstanding stock, as it continues to try and shore up its share price. Last year's NCIB, the company purchased about 800,000 shares at a weighted average price of $7.94 Canadian each. The company's share price peaked at $14 in July last year and recently fell to a 52-week low of $7.57 in February. So the company's obviously looking to pick up some cheap shares there and make itself a bit more competitive in terms of its peer group of royalty streaming companies. The big catalyst coming in its future is bringing the Hot Maden project in Turkey into production. And that will produce over 250,000 ounces a year for 11 years at a very low all-in sustaining cost. But that's still a good couple of years away. So the company's, trying to make itself more attractive to investors in the meantime.
And you noted that Standard Lithium made a significant hire, Paul.
Yes, the lithium space continues to be interesting. Lithium, obviously, one of the key elements of lithium-ion batteries, one of the key components of electric vehicles. So Standard Lithium has appointed former U.S. Assistant Secretary of State for Energy Resources, Francis Fanon, as a strategic advisor, as it advances its Lancis South Lithium project in Arkansas towards production. During his time with the State Department, Fanon oversaw the increasing awareness in the US about the need for domestic supply of critical materials like lithium that are needed for the energy transition and for the growth of EV batteries, EV vehicles. He was also previously managing director of diversified miner BHP. So great hire there.
Last piece of news before we bring back Doug Silver. This was a news that I noticed that ran through all of the major publications. Earlier this week, Greenland got a new left-leaning government, which was bad news for Greenland Minerals' Kvanefjeld rare earth mining project. According to Reuters, the leader of the new party would be halting Greenland Minerals projects. Shares of the company were suspended yesterday. They resumed trading today. It is currently priced at 11 cents a share. It started the week at 17 cents. The company also made a statement asserting that the focus of the project is rare earth, and there is a rhenium byproduct, but the company said it is low grade. Greenland Minerals said it has been working on this Kvanefjeld project since 2007, and an environmental impact assessment was accepted by the Greenland government last year. Now, we've mentioned it a couple of times, Douglas Silver, but I wanted to bring it back. What is the issue with pre-feasibility studies and preliminary economic assessment releases? You say that there could be a problem in terms of general investors interpreting these news results.
I've had the privilege of spending 40 years in this business, and both as a former CEO and as an analyst and everything else, one of our duties is to give the mining industry a good reputation. And one of the ways to do that is to be honest with investors, particularly retail investors who don't have the knowledge base and the sophistication that the institutions do. And my concern, and Paul, you brought it up, you started this, man. You're talking about a PEA and you're giving the IRR out to one decimal place. Yet if you go into that PEA and look at what the confidence level is in their capital estimates, it's probably plus or minus 35%. So where's that extra decimal place coming from? Fact of the matter is, when people come out and say we're getting a 39.5% IRR on a PEA, first of all, they're probably pre-tax, because most of them don't do after-tax, which is a mistake in itself. But you're also leaving them with the impression that you have a high level of precision in your numbers, and you absolutely don't at the PEA level. And as I said in my PDAC speech, PEAs are very, very important, but they're important internally for the company for designing future programs. But when they start rolling out these high IRRs and these low operating costs that have such huge variability and the numbers are so loosely defined, I think it's terribly misleading to investors. So that's why I'm against it.
I would agree with you there. The numbers that I gave just now in the news items were after tax, but I do take on board your criticism, because there isn't that high level of precision, and it can be very misleading.
Yeah, what they should do, and I have actually talked to the regulators about this. If you feel the need to put out an IRR, round it off. Don't give this fake level of precision. And the other is, in the banner, like right after you put the IRR, there should be a huge disclaimer saying these numbers are plus or minus 35 or 15 or whatever the capital cost estimate variability is. Because then at least the investor would realize that there's variability in the numbers and they're not tight. Because most people think of feasibility, whether it's definitive, bankable, they always think of them as very big, very expensive documents that have a phenomenal amount of data, but they don't understand that PEAs are so early stage that the numbers are often pulled out of dark, smelly places.
Well, I think you're right, because when you look at when the subsequent document comes out, the PFS, the pre-feasibility study, and there's been a few of those recently, almost always the CapEx is increased, and the IRR has decreased. As you get to a greater level of detail, right, the numbers can change quite significantly.
Yeah. However, they always say plus or minus. I've never seen one yet come in minus. They're always plus. And there's studies that show that they can be anywhere from 20 to 60% higher than what they originally projected. So if you have a 30% rate of return and you come in 60% higher, you just built an operation that's going to lose money.
Well, when and why did the nomenclature change? Because it used to be called scoping studies, and scoping study is a term that I would say most people understand. Implies it's a thumbsuck, and preliminary economic assessment sounds more important, sounds more studied, sounds more detailed. How and why did that change in nomenclature happen?
I don't know the details of it. It's probably all related to the formation of 43-101, where they were starting to define terms and put some brackets around as to what is contained within them. But those standards are not universally used. And it also, I said in my PDAC, it amazes me that the world's largest engineering firms, who play such a critical role in this industry, don't adhere to accepted standards. And again, the investors don't read 100 PEAs a year like I do, so they don't get the nuance of what's being done wrong or what's being left out. But at the end of the day, the investor's going to pay when the capital comes in on the next round and it's 40% higher and the operating costs go up. So to me, it's dangerous, and all it does is hurt the business, because when the capital costs go up, then everybody said, well, you lied. And the fact is, they didn't technically lie, because they used different estimating methods as they advance it. But it leaves that impression. And the one thing this industry doesn't need is to leave bad impressions. We've done a magnificent job in doing that.
In a sort of nutshell, what are the sort of 2 or 3 lines in a PEA that investors should really focus on? to sort of understand what the margin of error is or the risks are in the document they're reading.
I mean, the first thing I would do is look at whether it's a PEA or a PFS or a DFS or a BFS, whatever the category is, because for instance, in PEAs, the capital costs are usually plus or minus 35%, where in feasibility, they would be more like 15%. So just knowing what the variability is plays a huge role. The second thing I'd look at are the numbers that are being released pre-tax or post-tax. It's beyond me why they can't do them post-tax, because as far as I know, there's not a public mining company out there that's a church. They pay taxes, and they should be accounted. I mean, that's kind of like building a PEA and saying, well, we're not going to include G&A because it doesn't really matter how much we spend. It matters tremendously. I would look at those two things first, and then the last thing I would look at, and this is a little more complicated, but look at the relationship between the gold grade, if it's gold, look at the difference between the grade and the waste ore ratio, because you can't have a gold mine that has half a gram of gold and a 10-to-1 waste ore ratio and tell me it's going to be producing gold at 400 an ounce. It's not. It's mathematically impossible, which means they're playing games.
Niels, you wanted to come in.
Yeah, well, I just wanted to ask. I mean, if and you probably answered this question, but if a PEA is no good, and actually this is something that I've heard from a CEO is when it comes to this, sausages should probably be made in the dark. I liked that, and it's always sort of stuck out for me. But what should investors be looking at, if not the PEA? Like, what would you be paying more attention to when it comes to looking at a viable project? And I just wanted to add, like, I agree with you. I think, you see valuations now compared to where they were in 2011, and we're just not attracting the investment capital that we should be in. And I wonder if it's because we're not embracing the information. Like we're not, we still have this reputation of being shady.
Yeah. Do you remember Dr. Doolittle with Push Me, Pull You, the llamas? The problem that we're faced with is that companies have to demonstrate to investors that they're advancing the project and that they're progressing. So obviously, when you get your first set of economics and they come out positive, that's a plus. It's something you want to tell investors, and you have a shot if the numbers are strong enough that you're going to get re-rated because you're no longer an exploration company. Now you're on the edge of building something. So you're in this netherworld between being at the exploration level with that multiple versus being a developer with a different multiple. So that's a big piece of what's driving it. And also, of course, the company's spending a couple $1 million on these studies. They've got to justify, well, what did you get for your money? So that's what the mining companies or the mineral companies are doing. But from the investor's perspective, you ought to say, congratulations, you've got a PEA done. You now have a baseline to know that the project is worth continuing. And I understand that you're going to have to do a lot more detailed work and get proper bids and this, and this. The problem is most of them don't know to ask that question or to review it that way. But PEAs are very, very important because if you have to have a starting point as to whether this mine should be built. But I think that there's just too many investors that don't have enough sophistication to understand that the numbers that are being put out there, you should only say, is this PEA positive or negative? Oh, one other thing, since you're asking about short things, when you see a PEA that comes out and says, our internal rate of return is glorious 15%, you ought to immediately sell the stock, tell the company to reclaim the property and to walk from it. Because as Paul said, as you do more work, your capital goes up, your operating goes up, and your rate of return goes down. And if you're starting at 15, by the time you build that thing, you're going to be at like 3 or 4%. I'd rather put my money in good corporate bonds. So there's a minimum level. And when I see PEAs that are 30% or 40, I like that because it means they've got a huge buffer, which they're going to chew through as they do more work. But when I see these, I saw one PEA unnamed that had a 7% rate of return. Oh my God, abandon the project, cut your losses. That thing will never be viable at the metal prices or the commodity prices you used.
So I was just gonna, I that's interesting because like a regular investor would probably see 7% as absolutely fantastic because like I mean you look at where bonds are, you know what 1.78%. Hey, this is a fantastic investment, way better than bonds. Yeah, I've never this is opening my eyes. Really, really interesting.
So, Niels, look at it a different way. I don't really care what bond yields are. You go out and you're now going to build this mine, and you're going to go to one of the big private equity firms, or you're going to go out in the market and raise money, and you're a one-trick pony because you're a small company, right? We're not talking about the Barracks and Newmonts here. We're talking about the small companies. You're going to be borrowing money anywhere from 6 to 10% or higher. That's your cost of capital. So when you have a project that has a 7% rate of return and you're borrowing money at 10%, what do you think the economic outcome is going to be?
I'm not a math guy. That's why I'm a journalist. I don't do math.
I didn't mean to save this for the numbers section, but the point is, PEAs, you really need IRRs after tax north of 30% if you're going to get, at the end of the day, a project that's going to give you between a 10 and a 15% return. But if you start low, it's only going to get worse. And I've heard companies say this. Well, we told them we were going to build the mine, so we're going to build the mine. That's the last thing you should be doing. You should be watching the numbers and behaving and protecting your investors' money. Or if they lose money, they're going to tell all their friends, oh, I hate mining because I lost all this money because the guys lied to me because they gave these fictitious numbers.
Douglas, we're not seeing the PEA, the results that are coming out, and the companies fairly getting assessed within the markets if they have a certain PEA, as you say, like it would be, say, like a 7%. They somehow still have the ability to keep going, and the fact is that the market is just not uncovering this as being something uneconomic.
Well, the market doesn't recognize the problems with PEAs, and that's part of the reason I'm speaking out. Is those of us who read them every day, we understand these problems, and we can't believe some of the stuff we read. And then all of a sudden, they're doing a big financing, and it's like this is a lost cause. The industry needs to set, and I suggested this in my PDAC talk. The Canadian regulators did an excellent job with 43-101. Please tackle this and standardize definitions and standardize how you have to disclose it. And we're not talking about 2-point font at the bottom of a 5-page press release where you've buried it. Something up front where, a more casual investor, retail, millennial, will realize that the number that's being put out there has huge variability and therefore could go to the bad side.
Now, you had a great slide that I just loved, and I got to get familiar with you during your presentation at PDAC. You've mentioned it before. Surprise, surprise, miners have been announcing the dearth of mineral discoveries for a very long time.
Yeah. I mean, remember, I started out as an explorationist, and people who know me well know that I spent years building databases on discoveries. I had about 4,000 in my database, so I could look at the detailed statistics on what's going on. And I always notice every year when that slide comes out, it's always going down. It doesn't matter which year you take. And so, with the help of some friends, we pulled out these old ones, which were put out by very professional people. And you always see the same behavior. And then, of course, I explained why that is. But I really get tired of it when that's the reason why metal prices have to go up. Now, having said that, I will give you a variant on the theme, which is zinc. There hasn't been a really major zinc deposit discovered in a long time. But in the case of gold, I think those curves are meaningless, and they're used the wrong way because they're simply not true. It's that simple.
Just to emphasize that point, going back, you did have a presentation slide back in 1987, again, 1987, where the slide is up talking about the decline in mineral discoveries and, why this company should be going higher.
Yeah. Back in the 1980s, I wrote a book on this called Exploration or Extinction, and I'm sure I used the same graph there to sell the book.
Why do you call miners the greatest recyclers, Doug?
Well, one of the things that came out of it, when I did this big study for this speech, I assumed that what I was going to find is that there were there that the ounces were not going to be there. I just assumed after 30 years, and given the cutbacks in mineral exploration, particularly in gold, that we were going to see the discoveries drop way off. And, because of the social issues, it's harder to develop mines. I was really expecting the numbers to decline, but in fact, they went the other way. And it made me really look at it and say, why did I get it so wrong? And again, Paul, I'm going to reference your comments about Eskay Creek. You think Barrick today would like a deposit with 4 million ounces of gold? Sure, they would. So why did they give it up? And it's this bottom line is that once you have a gold deposit defined, that land is forever considered prospective. And of course, metal prices help. They go way up. Now you can go get the low grade. If they go even higher, you can go get the waste. Then we have, waste to waste ore ratios rather than ore to waste ratios. There's once the land is defined, it is forever reusable. And we've been doing this for, probably 1,000 years. So we are the greatest recyclers. We keep recycling these same deposits under different environmental conditions, political conditions, technological conditions, and price conditions. But they don't go away. So if you got a big one and it's not economic right now, if you can afford to hang on to it, eventually its day in the sun will probably come.
Lastly, talking your presentation, you really talked about North America and just how it kind of gains in preeminence just regarding its regulatory bodies. You mentioned before some of the work that we've done in terms of meeting regulations, but it really provides a transparency into North America, which gives it a huge benefit.
Yeah, I want to come at this one from two different angles. The first is, as a scientist, as a former geologist, the one thing that scientists like is knowing what the boundaries are. So when the regulators step up and say you have to do this, this, and this, we now know what's expected to us, so it's easier for us to meet those standards. The second is from investor relations, and I told you I spent years doing that as well. By having these regulations, investors are getting better information in general. And, I was hyping Canada because the U.S. mining industry is really quite vestigial at this point. Most of the companies busy in the U.S. are Canadian companies, but Canada is really the leader in transparency, and between the regulations for things like 43-101, what the mining companies have learned about what investors want to see, and the sort of the proactive approach between the regulators in Canada working with the mining companies on putting out a set of guidelines that really get information to investors. I think this is terribly important. And I picked on a few other countries where that just doesn't exist. And some of them, quite frankly, are appalling that anybody would buy a stock in that country's companies, given they don't put out any information. What are you basing your investment on? Hearsay? You're a relative of the company? It's but Canada has just done a magnificent job, and it makes it easier for guys like me that are building giant databases and researching issues of the industry to know that I can get the information. It sits out there, and the companies are quite generous as well. If you call them up and ask them for certain things, they tend to be very open and sharing, where other companies in other countries will tell you to take off.
Niels.
I just wanted to ask really quickly. I mean, do you think better information will bring investors back to the marketplace? What do you think? What do you think is needed to get valuation?
I would take that the other direction. I think bad information prevents investors from coming to visit. The only thing, as far as I can tell, that gets investors to want to invest in mining is when metal prices rise, and then all of a sudden they've got to be in the game. But in general, we're competing with some very good industries these days, particularly like high tech, which is revolutionizing the world, where we're still pretty much a basic industry. So I think the major driver that draws people to mining is higher metal prices. We do have a huge section that are speculators. I'm sure Paul can speak on this better than I can. But the millennials are putting their money into Bitcoin and cannabis, and they find that more intriguing. It's more novel. It's more cutting edge. It's not the old move dirt and pull metal out of the ground.
I wonder with the update in EV battery materials, if that's going to be blowing some, how would you say, some fresh energy and some fresh insights into the sector. There's, as far as uncovering good information, I just kind of look at it, and then, there's so much you could kind of do with natural language processing and, being able to use some machine learning to actually kind of sift through all of these and then, put together some good results. I mean, there are companies that provide this. I mean, my past company, which we were, with Mining Intelligence, also you have S&P, but if you're getting licenses for those things.
I think one thing that's very interesting about the battery and the critical element space is there aren't necessarily a lot of those projects around, and the PEAs on those projects that have come out have got some very low IRR numbers on them. So despite the fact that there's a well-known supply gap coming in a lot of these elements or metals, the projects, it's going to be very hard to get the projects there, one, through their scarcity, and two, just economics. So, will prices have to go through the roof to get these things moving?
So there's a couple issues there that need to be addressed. One is you got to give hats off to the lithium industry for making their metal the centerpiece of all the EV vehicles, even though you use 7 times as much copper in an EV vehicle as you do in a fossil fuel vehicle. Copper industry really missed the ball on that one, and give it to the boys in lithium. They've done a marvelous job. Now, with respect to rare earth, you have a couple things here that have not yet surfaced, but I think they're on the horizon, maybe later this afternoon. The first is rare earths are rare. So what does that mean? Well, geologically, it means that they're the last things that come out of magma gases, and they're very chemically complex because of the last things that come out of the gases. So the minerals they form are incredibly difficult to crack. And they're also low grade because they're rare. And so they're expensive, they're low grade. And, a lot of these rare earth minerals, they only use like 300 pounds a year in the world. So do you really want to build an XYZ mine that's going to produce 1,000 pounds a year? You're going to blow up the price. And you need a high price because they're expensive to produce. So I agree with you about there's very few good ones. There's an awful lot of bad ones. And the cost of production is requiring these companies to produce multiple metals. Well, if you have any background in metallurgy, when you design a flow sheet, you do it principally for one metal, and everything else comes out at whatever comes out. And I've seen a project recently where they're going to produce 5 or 8 metals, and they're all going to get 80% recovery. No, they're not. One of them might get 80, the others are going to get 30, 40, 20, and this whole area has not yet hit the forefront of the investors, but it's something that they should be very careful about because, again, I've read these PEAs, Paul. I know which ones you're talking about, and good first pass. They need a lot more work. They're going to have to develop new metallurgical technologies to crack them better, to crack them more economically, but a lot of that doesn't exist right now.
A lot to do.
Let's turn to our number of the week, a notable number. We always start with our guest. Doug, what's your number of the week?
Well, I have 2. Can I give you 2?
Absolutely.
First one is that 90% of all heroin addicts drank milk as a child.
Rock. Hitting the rock.
I now want to hear the second one. That was just fascinating.
There's truth, there's lies, and there's statistics. And if you're asking numbers, you're asking for statistics. Okay. So the other one, I'm going to tackle something Neil's brought up about the gold price. So Neil, I'm going to give you a variant on your theme. And I'm kind of hoping what I say goes viral and spreads widely.
We'll do our best. We'll do our best.
If you compare if you do a statistical analysis and compare the U.S. 10-year treasuries with the gold price, there's about a 90% correlation. So all this noise about, oh, gold's going to go up and blah, 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 blah. Listen, the reason gold went up right around Christmas time was because the treasuries were at the lowest they'd ever been. And now that they're going up, gold is coming down. And I haven't seen any statistic that correlates closer with gold prices than the 10-year treasury. So I would point people to that if they're making bets on gold prices.
I think that's a good segue into Niels. What's your number of the week, Niels?
Well, no, I want to put Douglas's feet to the fire here. How high do you think the 10-year goes then? I got to ask that question.
Well, when you look at the forecast for this year on GDP growth of anywhere from 4 to 8%, I think that the inflation rate, and again, the Dallas Fed was talking about this today. They think that inflation is going to kick in the second half of the year and could be quite dramatic. So none of that bodes well, because they're just going to have to raise the treasuries to pay for these little infrastructure projects.
Okay, so I will give my number of the week. It's a lot more optimistic than Douglas's. I had to give mine up because we did talk about ETF demand. But my second number is 412,000. That's how many ounces, 412,000 ounces, the U.S. Mint sold in their Gold Eagle coins in the first quarter of this year. And to put that into perspective, it's their best quarter. It took me about an hour to crunch all the numbers to go as far back as I did. The best first quarter start since 1999. So the best quarter since third quarter of 1999. So you can't ignore that there's strong physical demand in the marketplace. And we always see this when prices tumble. We see this pent-up demand, and we see people taking a lot more interest in the physical market. So a little bit more optimism there.
Well, I'm going to give two then. I'm going to have one in line with Doug's first one. I just made this up, but I imagine it's correct. 100% of silver bugs think the silver price is going higher. But for a real number, I've got a boring real number this week. Artemis Gold has basically picked the banks to organize its $360 million project finance for its Blackwater Gold project in British Columbia. They picked Macquarie Bank and National Bank of Canada to arrange that $360 million. The banks will underwrite 50% of that. And Blackwater, they're looking at producing an average of 248,000 ounces a year during the first phase, and they're going to have a three-phased development approach. I think that the total capex is going to be somewhere between $700 million and $1 billion over the three phases.
Did they have a first pour on that, Paul?
They're quite away from that, Michael. They've got a feasibility study coming out over the summer. So they're a little bit of ways to go before they have a first pour there.
20.5% is my number of the week. China's Utolite has announced that it has achieved a new world record of 20.5% power conversion efficiency for its technology for a mini module for solar panels. The technology is described as a game changer in the photovoltaic industry, and that number comes to us from BMO Capital Markets. We just noticed that the upcoming increase in solar panels in terms of the investments into renewables, and then also how that is driving the silver market. Douglas, did you have something?
Yeah, I just wanted to finish up with a quick comment. I mean, you guys have asked me some very controversial issues today, and it's been a lot of fun kicking them around. But you know what? The world is getting better with the growing economy. And I think Mr. Biden's infrastructure bill is about 20 years overdue. Mitch McConnell shut it down when Obama was in the office, and Mr. Trump did, as far as I can tell, nothing while he was in office. So people ought to realize, if you're a retail investor, that all commodities, I mean, we spend a lot of time talking about gold, but all these commodities, cement, zinc, lead, copper, rare earths, lithium, all these commodities are going to have a really good boom coming up because as the economy opens up, we're not only playing catch up. And remember, the human population didn't go down during COVID. It continues to grow. The demand for metals grow. But we're going to have this whiplash effect of an exploding economy, pent up buying, all of this coming in, and almost all of it takes metals. And then while you're also transitioning to a low carbon economy, that introduces a whole lot of other commodities that also are going to have a huge supply thing. So I don't want to leave people with the idea that I'm negative on the mining industry. I'm incredibly positive. I warned about this 10 years ago, and I think I'm going to be right. I think we're going to have a marvelous boom for the next couple of years in a lot of different commodities.
Doug, it's also had some highlights for you as well.
I do.
I was saying the mining industry has also had some highlights for you as well, Douglas.
Oh yeah. Well, I was honored to get into the National Mining Hall of Fame a couple of years ago, and I tell you, I love this industry. I work with students, I work with companies, and it's been a great ride. And I'm not done yet.
Reach out to us. You can follow me on Twitter at Michael McCrae. That's Michael McCrae with 2 C's. Neils is at Neils_C. Paul is at P Harris 1313. And how would you like people to get a hold of you, Doug?
If they want, they can get hold of me at DUGAG721 at gmail.com.
Hey, we're always looking for feedback on the podcast. Tweet at us, email us, or leave a comment below on the podcast. Do you like the format that we have? Is there something that you'd like to see more focus on? We're always open for suggestions. If you like what you hear, please tell a friend, and don't forget to subscribe through iTunes. On behalf of Neils Christensen, Paul Harris, and our guest Douglas Silver, have a great weekend and see you next Friday on Kitco Roundtable.